me start the recording. Right, so today we are going to be discussing last year's formal class test 2 question paper. So we're going to work our way through that. During the process, I'm going to mention a few auditing implications. The reason for that is I know that a substantial number of you are doing this course precisely to become an auditor. So we are going to be looking at that as well. Then also, I just want to revisit or revise a few things, some basic principles of accounting. Let's start by giving you a little test. Let's see who's the quickest today. So if you can type a little answer for me, I'm going to ask the question soon. So let's start by revisiting the conceptual framework for financial reporting. You all know that there are 5 elements, basic elements described in the conceptual framework, being income, expenses, equity, assets, and liabilities. The reason we're going to revise that is we need to know at our fingertips this morning what the implications are. Okay, are you ready to type something in the chat box? First question. If something is an asset, would that have a debit or a credit balance? Just type debit or credit. If it's an asset, there we go. Whoa, 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 whoa. Lots of answers and they're all correct. It will be a debit. Let's go to liabilities. If it's a liability, would that have a debit or a credit balance? Okay, you are quick, I must say, and you are sharp this morning. Let's go to equity. If it's equity, will that have a debit or credit balance? Nadine is especially quick. Yes, Annalisa, excellent. Credit, Belinda. Yeah. Okay, so if it's income, are we going to credit the account or debit the account if it's income? Quick. Wow, you are very quick. Excellent. Oh, there's one that had a little bit of a slip up, probably just a typo. And then lastly, if it's an expense, are we going to debit or credit that account? Fantastic, beautiful. You are very quick. I am very impressed. Okay, then let's just maybe revise what Dr. Smith discussed with you last week, the basic principles of an inventory system. We know there are 2 distinct kinds of inventory systems, a perpetual inventory system and a periodic inventory system. So let's maybe just discuss the main difference. As you know, when it's a periodic inventory system, the company does not have the means and ways, the proper records to keep track of the cost of the sale of every transaction, right? Whereas if they are using a perpetual system, they have sufficient, let's call it IT or accounting records so that they can keep track of that. So the implications of that are that in the case of a perpetual inventory system, if you purchase inventory, you are going to debit which account? Type it for me quickly. Which account are you going to debit if you purchase inventory when you are using a perpetual inventory system? No answers? Now, this time you've got to type the account name that you are going to debit when you acquire or purchase inventory if you are using the perpetual inventory system. You're going to debit? Not bank? Inventory, right? You're going to debit inventory. There we go, Lauren, thank you. So you're going to be debiting inventory. However, if you are not able to use a perpetual system, if you have to use the periodic system, especially like Dr. Smith said last week, in smaller companies, smaller businesses, then you simply accumulate the acquisition or there, Belinda, you're quick on the draw. You're already preempting what I was going to ask. I was going to ask, in that case, where do you accumulate your purchases, on which account? There you go, Leonardo, as well. You then debit the purchases account. Right. Now, just from an auditing perspective, interestingly enough, a company will, irrespective of which kind of inventory system they use, they will do an inventory count at the end of their financial year. Many of you may have arrived on a Saturday afternoon at Edgar's or Fushini or Woolworths, and they are normally open until 5 o'clock or 7 o'clock, and you get there at 2 o'clock and you see, oops, they closed, and there's a big sign in the window, closed because of inventory count or closed because of stock taking. So, like I say, irrespective of which system you use, you will do, from a business perspective, an inventory count at the end of the year, at least once a year at the end of the year. If you are using the periodic inventory system, that is your only means of determining the value at the end of your financial year, as you've probably now realized through the lessons that you've gone through and last week's session with Dr. Smith. In the case of a perpetual inventory system, you keep track of your cost of sales. So at the end of your financial year, you have a theoretical figure which you believe your inventory balance should be. But then you still do an inventory count. And if there is a difference, if there is a discrepancy, that is then probably a loss of inventory, right? So for some reason, some of your inventory got lost in the system. So the inventory count in that case, where you are using a perpetual inventory system, also then serves as an additional control. Maybe something had been stolen, something might have gone wrong through the course of the year. Anyway, that is just an introduction. I'm going to disappear from the screen now. My face will still appear there, just my profile picture. But then I'm going to show you what a typical test paper looks like. Now, clearly, you are going to write the test online, right? So you're not going to see a physical test paper. You are going to be answering your questions in an online test. But anyway, I'm just going to show you what last year's paper looked like. You can find it under the content per subject on the website, on our Blackboard website. I've made a few minor adjustments to the one that I'm going to discuss with you. It's just to make the explanation or explanations a little simpler, but it doesn't affect the nucleus or the gist of the paper. Okay, can someone just confirm to me that you can see the paper? Unfortunately, now that I've maximized the paper, I must, okay, let me minimize it.
You can see it, Mr. van Rensburg.
Thank you. Thank you. Can you now see it again?
Yes.
Oh, there we go. Okay, so that's what the first page looks like. And that is what the second page looks like. Right. Now, clearly, you're not going to see a question paper like that physically. You're going to get the same kind of information, but it will be in the form of an online test. Okay, so don't worry. I know it's small at this stage. I'm going to make it a lot bigger so that you can read it on whichever device you are using. Now, you know, when it comes to a question paper in financial accounting, the same applies with auditing, the same probably applies with cost accounting. We must accept it's a question paper, it's not a novel. So it's not the worst idea on earth to start at the end and see how your book ends. Yeah, in this case, it's not a novel, it's not a book, but it's a good exam technique just to go and have a look, first of all, at the required section. The reason I'm saying that, if you read the required first, then you get an expectation of what is coming. What are they going to be asking me? What is going to be expected of me? So if we look at question 1, and I'm going to scroll down, to the required section. What is required of us? We can see there 1.1, we must record the 2 transactions for February 2019 in the General Journal for the month ending 28th of February 2019. Okay, so there's a little bit of information in there, actually quite a lot. We also see that it counts for 8 marks, so that is quite substantial. So what can we read into that little sentence? Well, first of all, there are 2 transactions. Secondly, dates are always...
Van Rensburg, can you just ask students to ask questions on the chat if they have questions?
Yes, students, you've heard that. Please, if you have questions, please ask it on the chat. You will get an opportunity after we've gone through this paper to ask questions in person. But Dr. Smith will monitor your questions, and if it's something that I need to, or that she wants me to answer, then she will tell me. Otherwise, many of your questions simply be answered in the chat by Dr. Smith. Okay, so to return to required 1.1, so we know that there are 2 transactions. We know that February 2019 is the month that we are working in. We know, quite importantly, that a general journal entry, or entries in this case, will be required of us, right? So we've got an expectation already. Then in 1.2, they say by using the information related to March 2019 only, so now we're talking about the month after February, calculate the cost price per spare part. Okay, again, a lot of information, so we have to do a calculation. The information relates to March. We've got to calculate the cost price, and then we've got to convert it to a cost price per part. And then in 1.3, when are costs related to inventory capitalized or added to inventory? I'm going to make a little song and dance about that one later on. I'm going to provide you with quite a bit of information there, which I find, or which I feel is quite important, because it not only relates to inventory, which we find in IAS 2, International Accounting Standard number 2, but it all relates to many other kinds of assets. For instance, property, plant and equipment. Now, in the second semester of this year, you are also already going to start working on property, plant and equipment. And in financial accounting 2, we are going to do advanced property, plant and equipment. So when it comes to the cost of inventory, or the cost of property, plant and equipment, or many other kinds of assets, such as, for instance, intangible assets, they've got a very similar way in which you are prescribed to calculate the cost of it. Okay, we'll get to question number 2 a little bit later. The next page is question 2. So now let's get to the beginning of question 1. So here they say, Auto Spare Traders is a company in Cape Town that buys and sells motor vehicle spare parts. All right, so it's a trader, it's a trading entity, and it uses the Perpetual inventory system to account for inventory. So now we also know that they keep track of their cost of sales for each sale transaction. They carry on, they say all goods are sold at a markup on cost price at, I guess that should be of 50%. And for this question, please ignore value added tax. We're going to do value added tax very soon. I think it's within the next few weeks. Then they tell us during the course of February 2019, the following transactions took place. Those are obviously the 2 transactions that we must now record in a journal entry or journal entries. Firstly, Auto Spare Traders sold 2 sets of spare parts to a customer, Mr. Jack Stomper, on credit for 1,800 in total. And then secondly, Mr. Jack Stomper returned 1 set of spare parts because it was faulty. So there was a problem with that. So let's now just focus on the first one. I'm going to show you the solution a little bit later. But again, like we did earlier in this class, I want you to type some answers for me, and Dr. Smith will monitor whether you've typed the correct answer. Okay, let's just look at the structure of that journal entry. They say Auto Spare Traders. Now we know that is our company. We sold 2 sets of spare parts to a customer on credit for 1,000 rands in total. Now, if you can just type in for me, and then we'll look later on whether you are correct. Just type on for me. Which account are we going to debit? Yes, it will be debtors or accounts receivable. It is a customer. We are selling on credit, so we are going to debit debtors or accounts receivable, depending on what you as an accountant have has decided what you're going to call that account. Okay, which account are we going to credit? Not inventory, Lauren. We're still just talking about the sales transaction. Yes, Nadine. Yes, Sange. Yes, Kazimla. Yes, Akona, you've got it. So we're going to credit sales. Thank you. Thank you, students. With which amount? Type that for us quickly. Which amount are we going to use to debit debtors and credit sales? Type, 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 type. Yes, there we go. No rocket science in there. 1,800 rands. Excellent. There you go. Thank you, students. So that will record the sale part. But because we are using the perpetual inventory system, we also have to record the cost of sales. Right. We're going to look at that entry just now. First of all, if we are going to be using a perpetual inventory system and we want to transfer the cost of those items that we have actually sold, remember, once we sell them, they're not sitting in our warehouse or in our store anymore. They have been sold, right? So it's not part of our inventory that we own anymore. So which account, let's start with the easy part. Which account are we to credit with the cost of sales? If you can type that quickly. Yes, Nadine. I wish I could give you a prize for the quickest one this morning. There we go into Corso. Inventory, right? So we are taking the value of the inventory out of the inventory account. Remember what we said earlier, that assets have debit balances, right? Inventory is an asset. So if you are taking part of the inventory out of that account, it means we have to go and credit that account. Which account are we going to debit? Type, type, type. Yo, Nadine is quick. Yes, Lolita. Yes, Nadine. Cost of sales. There we go. Cost of sales. Ntokozo also quick. You've all got it right. Thank you. We will. Okay. Now, which amount? What is the cost of the inventory that we have sold? We've got to calculate that. So, how are we going to do that? We have seen there. There's a markup on cost price of 50%. So how are we going to calculate that? The cost price in this case will be the basis. So we'll set that as a 100. If you've got a piece of paper next to and a pen or pencil right there, 100. And then next to the 100, you write plus 50. And next to the 50, you write equals 150. Does it add up? 100 plus 50 gives you 150, right? Very easy sum. 100, that is our basis, plus 50 equals 150, right? Let me just minimize here. Let me see. Oh, you are so quick. I am very, very impressed. These students all deserve 100%, Dr. Smith. Okay, but anyway, just for completeness sake, now go and write the figures that you know. Go and write that there. What will you write below 150? What does the 150 represent? It represents the sale value. So that is represented by 1,800. You've all got that right. There you go. So in other words, what do you need to do now? You've got to multiply it by 100 because that is the basis amount that you wish to calculate. Thank you, Dr. Smith. She's given you the answer there, and you divide it by the 150, which represents the 1,800. Right, so that gives you 1,200 Rand. So now let's go and have a look at the solution. Let's see if we are correct. Maybe we've made a boo-boo somewhere here. There we go. Let's just look at the first one. Don't want to give away the secrets to the second one yet. There we go. We've debited for the sale, just for the sale. We've debited trade accounts receivable or trade receivables or debtors. Like I said, that depends on what you call it in your books of account. We debited that with 1,800 Rand and we credited sales with 1,800, right? And as you've correctly said, we now because we are using the perpetual inventory system, we take the value of the inventory. Remember, this is now the cost of the inventory that we have sold. We take it out of our inventory. We have physically taken it out of our store, or off our shelves, or out of our warehouse. So we've got to credit the inventory account. Remember, the inventory account has got a debit balance. It's an asset. So if we take it out of that account, we have to credit it. Where do we take it? As you've correctly said, we take it to cost of sales. So we're keeping track of the cost of the items that we have sold. All clear so far? No questions? Okay, so now let's have a look at the second one. We know that it was sold to Mr. Jack Stomper, who is a customer. Now they say, Mr. Jack Stomper, that customer of ours returned one set of spare part because it was faulty. Okay, so now when we sold it to that person, right? What did we do? We debited debtors, right? You remember, and we credited sales. So now we've got to reverse a little bit, do a little reverse trick here, and then we've also got to reverse the cost of the sale. Okay, so now let's maybe start with the easy side again. If that person returns the goods, does that person still owe the money for that returned item to us? Yes or no? Just type there quickly. No, thank you, Lolita. They don't owe us anymore. So we have already debited their account. Thank you for all those no's. Thank you, thank you, thank you. I'm glad I'm not asking anybody to the dance or to the prom, because then I would rather have seen yeses, but in this case, I like the no's. Okay, so no, it doesn't owe it to us anymore, but our account, our debtors account, shows that that person owes us the amount. So what do we have to do now? Do we have to go and debit debtors or credit debtors? There we go. You've got to go and credit debtors. Remember there at the top, we've debited the debtors. Thank you for all those perfect replies. Now we've got to show that that person doesn't owe us the money any longer. So we've got to go and credit that account. Remember, we sold units for 1,800. So this will be exactly half of that, right? Which account are we going to debit? I think I've already given it away. Remember, just again, we sold two sets. We sold two sets, so that was 1,800. They returned one set, so that means the sales value of that would have been 900 rands. Right. Yes, let me just see what you've typed there. Which account are we going to debit? Not inventory, Nompumelelo, because remember, we are now talking about the sales price, not the cost price. We will have to go and debit inventory because we actually received the inventory back, quite correct, but we have to debit it with a cost price. We've got some very good suggestions there. The one I like the most is Belinda's, who says sales return. Uh, got it, sir. Thank you. Please explain the 900 again. I'll explain the 900 again just now. Let me just, so Mandla, just be patient for a minute or so. Let me just talk about the sales or sales returns. We would like to teach you the basics correctly. So we would rather have you create a new account that you call sales returns, and then you can net it off at the end of the year when you do your trading account. I know in practice some accountants will simply debit sales. But you know, then you sort of you lose track over the year of your sales returns. So even though technically it would not be incorrect to debit sales, we would prefer you to create a new or a different account that you call sales returns. So let's go and have a look at that solution. And Mandla, then I'll get back to the 900. So there we go. We know we credit the debtors because they no longer owe us the money. But now we are going to debit either sales returns or sales with a 900. Like I say, both would be correct. It will depend on you as an accountant. Very often, you know, what we try and develop when it comes to your university training is professional judgment, not only the technical side of it, but also to be able to judge what you are doing correctly. So if you are carrying a sales return account, yes, you will debit sales returns, otherwise sales. Mandla, you asked, how did I get the 900 rands? Remember, we are talking about the selling price. So here in the first transaction, they said we sold 2 sets, right? Let me just highlight the 2 as well. We sold 2 sets, and the 2 sets had a selling price in total of 1,800. And now in the second transaction, they say one set was returned because it was faulty. So if the 2 sets are identical, which we have to presuppose here, that means one set would have had a selling price of 900 rand. So it'll simply be 1,800 divided by how many sets did we sell? 2 sets gives us 900. Does that answer your question, Mandla? There we go. Okay, good. Then we also must remember that inventory has now actually been returned to us, right? So physically we are going to put it back on the shelf. Well, if it's faulty, we're not going to put it back on the shelf, right? But it has been returned to us from our perspective. We will probably return it to our supplier who originally supplied it to us to say, look, this is faulty, unless we broke it, obviously. But if we received it as faulty, we're going to eventually return it to the supplier, and we're going to want a new one. But the fact is, until such time as we return it to the supplier, it's now back in our inventory, right? So it's in our store or it's in our warehouse. So if it's back in our inventory, which account are we going to debit? Type. Which account are we going to debit? No, I'm not going to show it before you've typed. It's back in our inventory. There you go. Nompumelelo, thank you. Kazimla, yes, there we go. You have got it. Thank you, Yamkela. We debit inventory. So it's almost again like a reversal of the previous entry. So which account are we now going to credit? Yes, Mkita, we debited inventory there. Quick on the button was Nadine again. Atunkosi, thank you. We are going to credit cost of sales. Remember, we debited that in the initial entry. There we go, Numpumelelo, thank you. So now we are reversing that for all practical purposes, right? So we are going to credit cost of sales. So again, let's maybe just go and have a look whether I'm not misleading you there. There we go. So we are going to debit inventory. We're going to get to how we calculate that just now, and we are going to credit cost of sales. Okay, so now the amount. How did we get the 600? Fairly simple, ladies and gentlemen. Once again, remember the cost of the items that we had sold originally was 1,200 rands. Right, so that was the cost of the item that we've sold, of the two items, I should say, and they've returned one item. So how do we calculate the cost of the one item that the customer has returned? We simply say 1,200, which represents two items, divide by 2. So 600 rands will represent the one item. Okay, let's pause a little bit there. Kazimla, you have given us the answer there. And to Corzo as well, thank you very much. Any other questions? Let's just pause there for a brief second. Is there anybody who wants to ask something besides in the chat box? Then you can just raise your hand. Doesn't seem to be any questions. Okay. Now, in order to do the second part of this required by using the information related to March 2019, which we're going to read through just now, calculate the cost price per spare part. Okay, now please listen to this little story. When Dr. Smith presented her class last week, when she took a little break, I also rudely not interjected, but mentioned the requirements of IAS 2, which are similar to the requirements of many other standards, including IAS 16, which deals with property, plant, and equipment, which you will be doing next semester, and in financial accounting 2, we're going to take it to a more advanced level. Now, the requirements when it comes to cost of inventory, and please make a note of this. I'm going to show you the solution a little bit later, but make a note about this already. If you've got pen or pencil and paper handy, this requirement relates to IAS 2, which deals with inventory and is titled inventory. Also, IAS 16, which is titled and deals with property, plant, and equipment. What is regarded as the cost of the asset? In this case, the asset is inventory. What is regarded as cost? There are two main components. The first component is your purchase price. So make there a little note. Firstly, purchase price. To put this fairly simply, maybe oversimplified, the cost price is simply determined by what you are going to be paying. Even if you buy it on credit, what you are going to be paying for the purchase of that asset, in this case, inventory. Then IAS 2 goes further and says what else must be included, in otherwise capitalized, as part of the cost of the inventory. And they say then directly attributable cost. Directly attributable cost. And then we go and define what is directly attributable cost. And they define it as follows. It is any cost that is necessarily incurred, any cost that is necessarily incurred to bring the asset, in this case inventory, to either a condition or location where it can be used as management intends, right? So to analyze that, it means, first of all, it must be a necessary cost. And then secondly, it must either bring the inventory to a condition where you can use it as management intends. What does it mean? What does management intend here? They intend, this is a trading entity, they intend to resell it, right? So that must be in a condition that they are able to sell it to their customers. Or to a location, a place where they can use it as management intends. Again, this is to sell the inventory. We are talking about a trading entity, right? So it must be at their premises where they can sell it. It must be in a condition that they are able to sell it. So now let's maybe just see, are there any specific questions on that? You can either type it or raise your hand. Doesn't seem to be any question there. Okay, so now let's go through what they tell us, and then you tell me, should this be capitalized? If it's not capitalized, let me just maybe complete the argument there. If it's not capitalized as part of the cost of the asset, in this case inventory, then it means it's going to be expensed, which means we are going to write it off to an expense account. So it's not going to be part of our cost of sales, it's being part of our expenses in the rest of our statement of profit or loss. Okay, so now if there's no questions, let's read this. This is the part that deals with March 2019. They say there, then during the course of March 2019, auto spare traders decided to buy 25 sets of spare parts from Australia, right? So we know they have bought 25 sets. We have seen a little bit earlier, we have to calculate the cost per set. So we know it's 25 sets. Then they say the invoiced amount for the spare parts was 75,000 rands. We'll talk about the shipping cost just now. Let's just talk about the invoiced amount. The invoiced amount for the spare parts, what does that represent? Maybe if you can type it there. I know it's a little bit of a longer phrase that you have to type, but what does that invoiced amount really represent out of the things that I've mentioned a few minutes ago? It starts with a P. Yeah, there we go. Great, Lolita. That's brilliant. Purchase price. That represents your purchase price. Thank you. Yes, purchase price is also good. I know what you were saying, Lolita. Thank you. Purchase price, purchase. Yes, Sange, that is the purchase. But remember, that only deals with the first component, the purchase price. So we haven't looked at the directly attributable cost yet. So now let's go to the rest of the sentence. They say the invoiced amount for spare parts was 75,000. So that is our purchase price. So by definition, we have to capitalize that as part of the cost of the asset, inventory in this case. They also say, and an amount of 10,000. Let me just maybe highlight that. And an amount of 10,500 rands was paid for shipping costs. Now, ladies and gentlemen, that is not part of our purchase price. What we have to do now is to determine, does it form directly attributable cost or not? And maybe to just repeat what we've said earlier, the reason why we are doing this, if it is regarded as a directly attributable cost, then it means it has to be capitalized as part of the cost of the asset. If it is not regarded as a directly attributable cost, then it means that cost must be written off as an expense. So it won't form part of the cost of the asset, it'll be written off as a separate expense. So how do we go about determining that? How do we ask ourselves questions to determine whether that should be capitalized as part of the cost of the asset or should it be written off? Very simple. If we look at that definition that we've spoken about a little bit earlier that comes from IAS 2, we ask ourselves a certain number of questions, 3 at a maximum. This question, and I'd like you to type in there yes or no. Is it a necessary cost? Yes or no? Is it necessary? Do we have to incur that cost? Lauren, thank you. Lolita, thank you. Belinda, thank you. Yes, yes, yes. If we do not incur that cost, we cannot. Thank you, everyone. Nkosi, Inga, everyone. We have to incur that cost. Otherwise, it's not. Otherwise, it's going to stay in Australia, right? If you know what I mean. It's going to stay there in Australia. They have to ship it to us because we are here in Cape Town, as we've seen earlier. Then the second question that we have to ask, and I know that we don't always have to ask all 3 questions, but I'm going to ask it in such a way that we always have to ask the 3 questions. Does it have an effect on the condition of the asset? Does it change the asset itself? Yes or no? No, 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 it doesn't. You're all correct. You're all correct. It doesn't change the condition. So possibly it's not a directly attributable cost, but as we said, that's not the only question we must ask. The next question that we must ask, and please again type yes or no for me, does it have an effect or does it change the location, the place of the goods? Nompumelelo, yes. Zamkita, yes. Sangi, yes. Sia, Tunkosi, Lilita, and Tunkosi. Wow, you are quick. Yes, it changes the location. So if it is a necessary cost and it changes either the condition or the location of the goods, then it is seen as a directly attributable cost. Mandla, not sure. Yes, it does. The only reason you are paying for what did they call it, transport, what is it, shipping cost, is to change the location. You are shipping it from one place, from point A to another place, point B, right, Mandla? You get that? So the whole point behind shipping costs is you are going to move the goods from one location to another location. Got it. Thank you, Mandla. Okay, ladies and gentlemen. So to cut a long story short, that means that cost is a necessary cost and it does change the location of the asset, which then means it has to be capitalized as part of the cost of the asset. We're not going to write it off as shipping expense. We're going to capitalize it as part of the cost of the asset. Perhaps we can just briefly talk about the accounting implications as well. If you are using a perpetual, maybe you can type this in for me as well. I know it's not that long. Type this in for me as well. If you are using a perpetual inventory system, which account are you going to debit with that 10,500? Is it going to be some sort of expense, or which account are you going to debit? Lauren, this case, not shipping costs. Sia, you've got that right. Ntukozo, not carriage. Remember, this now forms part of the cost of your inventory. So you're actually going to debit your inventory account. Not import duties either. Remember, the fact that it forms part of the cost of your inventory means you're going to debit inventory. So there you've got a little bit of a new angle on things. You would have debited import duty, not import duties in this case. We'll talk about import duties soon. You would have debited another account, maybe shipping inwards or carriage inwards or whatever, if you had been using the periodic inventory system. But even then, at the end of the year, that cost will then be debited to your cost of sales account, right? So in either case, it'll form part of the cost of your inventory. Okay, let's go to the next one. To celebrate the purchase, so they're very happy that they've imported these goods. To celebrate the purchase, 5,200 rands was paid for a staff party. Let's maybe just pause there. So 5,200 rands was paid for a staff party. Should that be written off as an expense? We know it is an expense because they paid for it. There was a staff party. They bought the food, and let's not go any further. What else? But anyway, say food and drinks. To celebrate the purchase, they paid 5,200. So should we write it off as an expense? Should we capitalize it as part of the cost of the asset? So let's go through our little formula again. The first thing that we have to ask ourselves, and you can type in an answer yes or no again for me, is it a necessary cost? Yes or no? Belinda has already gone a step further to what I'm going to ask. There you all go. No. It's not a necessary cost. We can do without the party. The party is a nice to have. I agree. Very convenient, very pleasant. Everybody's happy after that, but it is not essential, right? So if the company didn't have a little bit of extra cash, they wouldn't even have had the party. So we don't even have to go any further. If it's not a necessary cost, then it's not a directly attributable cost. Then clearly we have to write that off as an expense. But even if you had, for argument's sake, yes, it's necessary, then you could ask, you could go further and ask the other two questions. Does it change? And maybe you can type it again there, the answers there for me as well, just a yes or a no. if you had been wrong and you said that it is necessary, does it change the condition of the goods? That party, does the party? No, it doesn't change the condition of the goods. So that means it's not a directly attributable cost. But remember, there's a third question. Does it change the location of the goods? No. There we go. We've got hundreds and hundreds of no's. So if it doesn't change the location of the goods or the condition of the goods, then clearly it cannot be a directly attributable cost. Okay. So that one, that 5,200, thank you, students, for that answers, for those answers. That means it's going to be written off as an expense. So let's go to the next part of that same sentence. They say they also paid an amount of 9,200 rands for import duties. Now remember, this comes from Australia. We imported it into our country, South Africa, here. So they also had to pay 9,000 rands for 9,200 for import duties. So should we write that off as an expense, or should we capitalize that as part of the cost of the asset? Now we know it's not part of the purchase price, so what we need to determine now is it a directly attributable cost? So let's go through the process again. First things first, is a necessary cost. Can we do without paying the import duties? Can we get it to our premises without paying import duties? That's the tax that they slap on us, you know, customs when it arrives at the port. Okay, let me tell you, I see a lot of yeses there. The shipping agents from Australia delivers it to the customs here in Cape Town Harbour, or to the customs at the international airport. Now it sits in customs. The customs, what are those customs officers going to do? They're first going to see whether it's not contraband, right? Whether it's not drugs or arms or something that you don't want into the country. And if it's something that is legal, not illegal, if it's legal and they want it to enter the country, they're going to slap a tax on it. And they're not going to let you come and fetch the goods unless you pay the tax. So those goods are going to lie there in the customs warehouse at the airport or at the harbour without you being able to get it. So can you get the goods to your premises without paying that import duty? Type again, especially those who said yes previously. There we go. No, you can't. You can't use it. It's just going to lie there, and you know, when they get out of space, they're just going to send it back to Australia, or as we know nowadays, they'll just use it themselves or something. I probably shouldn't have said that, but you know how it goes. Okay. So the fact is, it is a necessary cost. Now, again, I'm going to ask the other two questions. Sometimes you only need to ask one, but I'm going to ask it in such a way that we have to ask both additional questions, all three. Does the fact that you have paid the import duties, does that have any effect on the condition of the goods itself? Yes or no? Does it change the goods? No, there we go. Thank you, Ntokozo. Thank you, Leonardo, Asipe, Atunkosi, Mandla, Lolita, all of you. Thank you. No, it doesn't change the condition of the goods. However, does it change the location? Here you've got to think a little bit out of the box. Does it change or have an effect on the location? Yes, it does, because it's now sitting in the warehouse belonging to the customs officers, and you cannot move it. You cannot take it to your premises. So in order for you to go and collect it and take it to your premises, move it from customers to your shop, it means you are changing the location of the goods. So it is a cost that has a bearing on the location. So therefore, ladies and gentlemen, it will be regarded as a directly attributable cost, and you are going to capitalize that as part of the cost of your inventory. You're not going to write it off as an expense. Hope that is clear so far. Let's go to the next sentence. Once inland, okay, so it's now been cleared by customs. We are able to fetch it. They say all the spare parts were delivered to the store in a truck of auto spare traders, and 2,600 rands was paid for employees to have lunch when they were transporting the spare parts. Interesting. It was also decided that orders have been placed. Okay, we'll talk about that just now. So where were we? That part, the 2,600 rands that was paid for employees to have lunch when they were transporting the spare parts. This might be tough on some of you, but the first question that we've got to ask, is it a necessary cost? Got a little bit of a difference in opinion here. But the answer is, well, they could actually have delivered it without having the lunch. If they had been talking about, let's say, the fuel that was used by the truck, clearly if the fuel used by the truck cost us 2,600 rands, then it is necessary, right? But in the case of the lunches, it is not actually a necessary expense, right? Even if you had said it's necessary, then we can carry on. We can ask the other two questions. Does the fact that your drivers or the people that have loaded, Mandla, you've already understood, thank you. We can go further. We can say, does the fact that they're having lunch, does it change the condition of the goods? Yes or no? We all know it doesn't. Thank you, everyone. Does it change the location of the goods, the fact that they're having lunch? No, it doesn't change the location either. Like I say, if that had been an expense dealing with, let's say, the fuel, that would have had an effect on the location of the goods. So clearly, once again, in this case, it will not be regarded as a directly attributable cost, which means it is not going to be part of the cost of your inventory. You're going to write that off as an expense. You'll probably just call it staff benefits or some appropriate name that it can be. It's going to be written off in your statement of profit or loss. Okay, then just the last part of the sentence, the paragraph, I should say, the last sentence of the paragraph. It was also decided that orders that have been placed by customers in February 2019, last month already, would receive free delivery, costing auto spare traders 1,220 in total. Right now, we've got to be very careful here. They say the customers would receive free delivery, right? So that cost, does it have an effect on getting the inventory to your premises? The location of the inventory to your premises where you can sell it from? Or does it have an effect of getting it from your premises where it was already ready to be sold to your customers? I know that is a hard one to type. Right, so that cost is incurred. Thank you very much. That cost is incurred after the inventory is already ready to be sold. It's already in a condition and location where it can be used as management intends, but now you are going to provide free delivery to your customers, right? So that is not a cost that you incur in bringing the inventory to your premises or to a condition where you can sell it. It is basically a service that you are providing after the inventory is already ready, if you know what I'm saying, right? So in that case, it will not be seen as a directly attributable cost. It will be written off as an expense. Now let's go and see how much did I mislead you with. There we go. What should be capitalized as part of the cost? First thing, the invoiced amount. We said that represents the purchase price, right? And then we are looking at all the various directly attributable costs. The one that we've identified is a directly attributable cost, was the transport, or what did they call it? Just go and have a look again. Shipping cost, the shipping cost there, right? The shipping cost that was paid by to transport it from Australia to South Africa. So that was added to the cost, as well as the import duties. The import duties, which is also a necessary cost, as well as something that changes the location of the assets. All right. So we simply go and add that up. That gives us our total cost. So it'll be 75,000 plus 10,500 plus 9,200. I haven't calculated this myself, but hopefully that gives us 94,700, right? So that is the cost that we are going to capitalize for the inventory. But they also asked us, or they actually asked us, what is the cost price per part? So now we've got to go and have a look. How many parts did we import? There we go. We imported 25 sets. So if we imported 25 sets, that is the total cost of all 25 sets. We divide it by 25. That then gives us the cost price per, or the cost per set, right? So the cost price, there we go. There's our answer. The cost price per spare set, or the cost price per spare part, I should say, is 3,788 rands, right? Any questions so far? We can just perhaps do that. Yeah, maybe let's just pause there briefly if there are any questions. Okay, then just the third part, I've changed that a little bit, the solution, I should say. I changed that a little bit to give you the full picture. There they ask you theoretically or in accordance with IAS 2, when are costs related to inventory capitalized? In other words, added to the cost of the inventory, and more other words, not written off as an expense then? And there we've got the answer. It must be a necessary cost, and that cost must be incurred to either get the asset to a location or place where it can be used as management intents. In the case of inventory, it will be sold. When we are going to be doing property, plant, and equipment, what is the intention of management? Let's say it is machinery, plant, and machinery, then it is to use in your factory, excuse me, to produce goods. Or it must have an effect on the condition. Condition, for instance, let's just say if you're importing it from Australia, but it has got electrical plugs that doesn't work in South Africa, and you've got to replace it with electrical plugs that can fit into a South African socket, and that costs you maybe 10 rands per item. Then it means it changes the conditions so that you are able to in South Africa, which then means it is going to be regarded as a directly attributable cost and then capitalized as part of your inventory. Where I'm going down instead of up. Okay, before we do question 2, perhaps let's just pause here. Any questions from your side? I'm going to take a 2-minute break just to gulp down some coffee here, which is now ice cold, but it's still better than nothing. So this is a good chance if you want to ask questions or if you have any queries on question 1.
Mr. Jansen van Rensburg, can I just say something to the students?
Please do, Dr. Smith.
I just want to remind them that there is a quiz available on Blackboard on inventories, and I really recommend that they go and do the quiz. I hope you can see my screen. If you go to topic 7,
yes, we can.
For trading entities, this is what you're going to be tested on tomorrow. And then if you go to part A, how to calculate cost and selling prices, you also need to know this for tomorrow. Under the learning content, you will find slides and a video, but at the bottom of that page, there's a quiz. And remember, all of the revision quizzes together count as one class test. They will stay open for the whole year. You can do them as many times as you like. But this quiz is important for you to do a revision for the class test, which opens tomorrow. So I'm encouraging students to please try that revision quiz and as part of their preparation for the test. Okay. Students, are there any other questions about the test for tomorrow? It opens tomorrow at 6 o'clock in the morning and closes Monday evening at 6 o'clock. No questions about the test.
Thank you, Dr. Smith. I have also used this little opportunity. I don't know whether I'm just cold or whether the weather is changing, but I've used the opportunity to go and put on my nightgown again because it's possibly the warmest thing I've got. While you're talking about the test, thank you, Dr. Smith, for that. It reminds me, your tutor, Ms. Sanalasiwe, she asked me yesterday, please, students, do not ask her questions on WhatsApp about the test. Okay. While you're while you're preparing for the test, which is still today, but you can obviously ask her questions. But once the test opens tomorrow morning at 8 o'clock, you're not allowed to ask her questions, and she's going to ignore you. Okay, she's not going to answer any questions. So she just asked me to specifically mention that. And then also, because you are writing the class test from tomorrow morning, 8 o'clock till 6 o'clock on Monday, there will not be a tutor session either tomorrow or Saturday. Okay, so let's go and have a look at question 2. Let me just share that screen again. There we go. Okay, so let's look at question 2 once again. Maybe just go and look at what is required of us so that we can, there's a lot. So we can create an expectation of what is coming up. So they say they use the information provided above, which we're going to look at just now, to calculate the following for all spare traders for the year ending 31st of December 2018. So there we've got the year end. We know that it ends at the 31st of December 2018. They want us to go and calculate net sales, net purchases, right? So 2 marks each. So we're going to have to do those calculations. Secondly, prepare the following accounts as they would appear in the general ledger for the year ended 31st of December 2018, right? So we know now that we'll have to go and draw up T accounts, general ledger accounts. Which ones? The cost of sales account and the trading account. Thirdly, we must provide the closing general journal entry, close the purchases returns account at year end. So we know a journal is required to do what? To close the purchases returns account at the year end. Let me see, that's the last one, yes. And then fourthly, indicate whether the following statement is true or false. Gross profit is equal to sales less cost of sales. Let's do that one. Let's do that one. That takes us 5 seconds. Gross profit is equal to sales less cost of sales. True or false? Tap, tap, tap. There we go. True. Yes, yes, yes. True, 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 true. No, Manla, it is actually true. Thank you all for all of those answers. Yes, so your gross profit is calculated by deducting or subtracting your cost of sales from your sales figure. Okay, now let's start with the first requirement to calculate net sales and to calculate net purchases. So let's read the rest of or this main body of this question. They say, spare me. A spare part trader has been in business since March 2009, and I guess that should be it, I'm sorry. And it has been making use of a periodic inventory system. Okay, so this is different from question 1. In this case, they are using a periodic inventory system to account for inventory. At the 31st of December 2018, the financial year end of the business, the following information was made available by the owner. So here we've got sales, 95,800, purchase 71,400, railage inward, so that will be a directly attributable cost, 8,130. Railage outward, that is not part of the cost of the inventory, 9,040 rands. Inventory, 1st of December 2018, so that means it is our opening balance at the beginning of the year. And then they did an inventory count there, probably on the night or the evening of the 31st of December 2017, and that is the opening balance for the new financial year starting on the 1st of January 2018. And then our inventory, 31st of December 2018, that is at the end of this current year. So clearly on that day, the last day of that financial year, they did another inventory count, or stock take as they sometimes refer to it. And they counted the items, they costed the items, and they determined that the value of the inventory in their warehouse and on their shelves everywhere on their premises amounts to 11,820 rands. We had sales returns of 19,720, which is doesn't sound like the greatest customer service policy, but anyway, and purchase returns for 12,450. Okay, so let us calculate net sales. Our net sales will simply be the sales for the year, right? 95,000 rands 800 less the sales returns. Now you remember earlier when we were discussing question 1, we said that some accountants will have, and this is advisable, will have a separate account called sales returns, especially if you are using a periodic inventory system. Keep that separate. Sales returns of 19,720. So your net sales, your actual sales that was processed, that were completed successfully for the year, will be that 95,800. Yes, less 19,720. Let's see if we are correct. Ooh, I think I went way past that. There we go. 95,800 less 19,720. So there we get our answer. Let me just see what you've typed there. 76080, Londeka, Lolita. Thank you for those answers. You are absolutely spot on. So that will be 76,080 rands. Okay. The second one is our net purchases, right? So let's see what our purchases amounted to. Our purchases that we actually bought from our suppliers amounted to 71,400. But during that year, we returned some of it to the supplier because they were faulty, or it was the wrong kind of item, damaged, or for whatever reason. So we've returned some of that. So we purchased to the value of 71,000, but we returned to the value of 12,450. So again, you can type the answer for us there. It'll simply be 71,400 less 12,450. So there we've got an answer. 71,400 less 12,450. Thank you for those answers. That gives us 58,950 rands. Right. Thank you, students. Thank you. Then we must prepare the following accounts as they would appear in the general ledger for the year ended 31st of December 2018. Let's start with that one first, our cost of sales account. Okay, what is the very first thing that we have to remember here? We have to remember we are using a periodic inventory system, right? So we haven't kept track. We haven't traced our cost of sales throughout the year. We've only got the value of the inventory in our inventory account at the beginning of the year. Maybe you can type there quickly that balance on that account, is it a debit or a credit at the beginning of the year? Type debit or credit in the inventory account at the beginning of the year. It's an asset, remember? Yes, it's there we go, Lolita, Zankita, Atnkos, thank you, Manla, Landeka. Yes, it's an asset, so at the beginning of the year, it's going to have a debit balance. But that debit balance we have to transfer from the inventory account to the cost of sales account. So if we are going to transfer it out of our inventory account, if we're going to transfer it out to the cost of sales account, what do we now have to do with our inventory account? Debit it or credit it to take that balance that is a debit to take it out? Yes, Nompumelelo, Atinkosi, Sia, thank you very much. Now we've got to go and credit that account, which means what are we going to do with our cost of sales account? We're going to debit it. There we go. So let's go and look at our first entry there. Thank you very much. You are all correct. I'm scrolling down too far. So this is actually going to be our first entry. Let us just go to the question again. There we saw our inventory at the beginning of the year, 1st of January 2018, was 7,680 rands. You've already said yourselves it is a debit balance. So if we are going to take it out of the inventory account, we're going to credit inventory and we're going to debit cost of sales with that. So there we go. That is our first one. It comes from our inventory account. So the source, the credit, it comes from our inventory account. We're going to debit the cost of sales account. Okay. Right now we've go and see what other costs have we incurred during the cost of the year that is part of the cost of our inventory. First of all, our purchase price, the sum of the units, or the sum of all our purchase prices, right? On which account have we accumulated, in the case where we are using a periodic inventory system, on which account have we accumulated all our purchases throughout the year? On the purchases account, right? So if we've accumulated that as a cost, what is the total of that transactions at the end of the year? A debit or a credit? You can type that for us quickly. All those purchases that we've done during the course of the year, when we recorded them, we would have accumulated them on that purchases account. So at the end of the year, that total balance, is that going to be a sum that represents a debit or a credit? Debit. There we go. Lauren, Belinda, Ntukozo, Nkosi, Lolita, thank you. Yes, debit. So we are going to take it out of the purchases account because we want to take it to our cost of sales account. So if we want to take it out of purchases, what do we have to do with the purchases account? Debit or credit? There we go, Lauren. There we go, Lolita. There we go, Ntukozo. There we go, Atnkos. Thank you all, students. So it means we have to credit the purchases account. Where are we taking it to? We are taking it to the cost of sales. What was that amount? 71,400. So let's go and have a look. Oh, sorry. What did I just do? The net purchases, what, 58? Let me just get purchases less purchase returns, 71 less 12,400. Let me just get that answer quickly. There we go. 58,000. Remember, we must take the net purchases, right? So it'll be the 71,400 less the purchase returns. So the amount is actually 58,950. So we credit the purchases account with 58,950. We take it to cost of sales. Excuse me. So we're going to debit the cost of sales with the net purchases, right? So it comes from there, the amount. In other words, the purchases, the gross purchases, less the purchase returns. Then, did we have any directly attributable cost? Railage inwards. Is that directly attributable cost? In other words, part of your cost of entry up there for me? Yes or no, please? Yes, Belinda. Yes, Lauren. Yes, Manda. Yes, Ntukozo. Yes, Sia. Yes, everybody. Thank you very much. So that means it is going to be part of your cost of sales. So that account also needs to be closed off to cost of sales. So that railage inwards, as we know, that is an expense, except that we are not going to write it off as an expense. We're going to capitalize as part of the cost of the asset, in other words, part of cost of sales. But it being an expense before we write it down to the cost of sales, does that represent a total of debits or credits? You can type me there, please, debits or credits on that account. Debits, there we go, into Kozu. There we go, Mandla, there we go, Belinda, and so forth, thank you. So those are debits. So now we are going to transfer it out of the railage inwards account, and we're going to transfer it to the cost of sales. So if we are going to take it out of railage inwards, what do we have to do with that railage inwards account? Debit it or credit it now to take it out? Credit. Thank you, Atunkosi. Lauren, thank you, credit. So now we're going to credit it, which means the contra account where we are taking it to, which is our cost of sales account, is debited. Right, so we're going to debit it with 8,130. Let me just go and have a look there. There we go. Right, so we're closing off, we're totally closing off the railage inwards account. So whatever balance sits on the debit side, we close off that full balance by crediting that account, and we take it here to our cost of sales. Right, so we started with our opening balance, we added the net purchases, we added the directly attributable cost. Right, so the only other, or two other things, but one other thing we must still do, remember when we took the balance, where are we? Let me just go back. When we took the balance of our open inventory to cost of sales, we took it out of inventory. So at this stage in time, at this point in time, what is the balance on our inventory account? It is 0, right? It is naught. We haven't got a balance because the opening balance we have now transferred to cost of sales. So at this stage, it has no balance. But do we have inventory at the end of the year, that we've determined after our inventory count? Yes or no? Do we have physical inventory in our store? Yes, Lilita. Yes, Lauren. Yes, Ntukoza. Yes, Atunkosi. Yes, we have, right? So because we have physical inventory, it means we have to carry a balance for that inventory. So that means if we have to carry a balance for the inventory, which we have at the end of the year, that balance that we've determined through our inventory count, it means we have to carry a balance for that. In which account will we carry a balance? In our inventory account, right? In our inventory account. So this means we now have to go and debit inventory with that 11,820 in order to carry a balance at the end of the year that we can disclose in our statement of financial position under current assets as inventory, right? So that means what do we have to go and do with our inventory account with that one? 11,820. If we want to carry a balance, do we have to now go and debit or credit the inventory account? Oh, no, 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 no. Remember, we now want to carry the balance at the end of the year, and it is an asset. Gosh, no! There we go, Lauren. Gosh, no, Atenkosi. There we go. Thank you, both of you. Thanks, Belinda. You're a little bit ahead of us there already. Yes, so we are going to debit the inventory to create a debit balance on that account. And as Belinda has typed there, our contra entry would be to credit the cost of sales, right? So that we can now go and have a look at. There we go. So we're going to debit inventory account with the amount of inventory that we are carrying at the end of the year. We've determined that through our inventory count, our stock take, in other words, 11,820. Okay, so that means we have now determined the cost of the sales, right? We have taken into account what the amount of inventory was that we had at the beginning of the year. We have taken into account our net purchases for the year. We have taken into account any directly attributable cost that should form part of the cost. We have taken into account what inventory that we have purchased during the year, or perhaps even was part of our inventory at the beginning of the year, hopefully not. But anyway, what inventory is not sold yet? What is the value of the inventory that's still either on our shelves or in our store? That's 11,820. So that means the cost of the items that we have sold during the course of the year, that is why we call this account cost of sales. The cost of the items that we have sold amounts to 62,920. Right, so that is a figure that we can already see a little bit into the future. It's an amount that we are going to use in our statement of profit and loss. That will be our cost of sales. But now we've got to close off this account. We've got to close it off its entirety. So whatever the balance on that account is, and if you add that up, it adds up the debit side, which is the largest side. It adds up to 74,760 rands. You copy that total over to the opposite side, 74,760. You deduct the only credit entry there, and you see that your balancing figure on this account is 62,920. So if you wanted to ask how do we determine that, it is simply your balancing figure. You add up the bigger side, the debit side in this case, you copy that total over to the credit side, you deduct whatever the total entries on that credit side is, and your balancing figure, you don't carry it forward because it's a cost. You write it off at the end of the year. Where do you write it off to? Trading account. So it means you're going to credit your cost of sales and you're going to debit the trading account, right? So there you're going to debit the trading account with the cost of the sales that you've just determined there, 62,940. So there are two further steps. The next step is now we've got to take our net sales to the trading account, right? We've already determined what is the value of our net sales. We said is the gross sales, our total sales recorded, less the sales returns, gives us our net sales for the year. Okay, let us ask a very, very quick question again, and you can type the answers. We have recorded the sales, all the sales that happened during the course of the year on that sales account. So at the end of the year, that total of the sales, is that a debit or a credit balance? Debit or credit? No. Sales income. Sale is an income. Yes, Belinda. Remember, sales represents income. Income, that's why we said right at the beginning of this class when we discussed the elements in the conceptual framework. What is the total? What do you do with your sales account every time you make a sale? Do you debit it or credit it? Type for me there. Every time you make a sale, you credit it. There we go. Right, sales is revenue, correct. So you credit it. So if you take all those sales at the end of the year, if you add them up, what kind of a balance would that account have at the end of the year? A total of credits or a total of debits? Credits, right? So it's going to have a total of credits. So your total balance, the sum of all your credit, all your sales transactions, thank you Mandla, thank you Ntukozu, at the end of the year will be a credit, right? So now you want to take it out of your sales account because you want to transfer it to your trading account. So if you want to take it out of the sales account, what do you have to do with your sales account? Debit or credit? Yes. There we go. All of you, thank you. So now to take out the credit from that account, you have to debit the account, right? And we've seen that the net sales gross less the sales return, 76,080 rand. So that will be the total of your credits. So you debit your sales account, you take it to the trading account, which means you are going to credit. Sorry, where are we? There. Sorry. There. There we go. There we go. So we've debited sales to get rid of the balance. Remember that account needs to be closed off. It's a nominal account. It needs to be closed off at the end of the year. So we debit that account with whatever the total credit on that account balance was, and we transfer it to the trading account. So if we have debited sales, it means we are going to credit the trading account. Right. Okay, so we've got our cost of sales, we've got our sales. So now it is simply a matter of transferring that to our profit and loss account, or profit or loss account if you wish. So how do we do that? Again, we add up the highest side. In this case, the biggest side is the credit side. We add it up. We've got a total of 76,080 rands. We copy that total over to the opposite side, to the debit side in this case. There was at that stage only this one entry there. So now the balancing figure, in other words, 76080 less 62940 gives us the balancing figure of 13,180 rands, right? And that, where are we going to transfer that to? Our profit and loss account, right? So that we then go and look at our other incomes on that profit and loss account. There we're going to look at our other expenses and so forth. But the fact is our our gross profit in this case will be transferred to the profit and loss account. So in effect, what comes here from the trading account is the gross profit. So that also answers that last part of last question of question 2, where they asked, is it so that your gross profit equals sales less cost of sales? Yes. Why? There we have sales less cost of sales gives us gross profit, right? So there's another way that you could have arrived at the answer for the last part of this question. Okay, let's take a little breather for 60 seconds. Any questions before we go to part 2.3? That 2.4 is the one that we've just answered as well. Any questions from your side? Thanks, Mandla. Got it now. Okay, there doesn't seem to be any questions. So now let's go to, we've already answered 2.3. So the last part for us is to provide the closing journal entry to close the purchase returns account at the end of the year. Before we even look at the details, if we have purchases, let's just talk about purchases. Forget about purchase returns now. If we have purchases, right? Purchases, would that be debits or credits? Just type there, debits or credits. Purchases, remember it's an expense. Debits, thank you, Belinda. Thank you, Nadine. Yes, debits. So thank you, Ntokozo. Debits, there we go. So clearly, purchase returns, which we are talking about now, will be the opposite of that. So would that be debits or credits in the case of purchase returns? Thanks, Leonardo. Thanks, Sia. Thanks, Lauren. Thanks, Mandla. And Ntokozo, yes, so they will be credits. So we already know that when we are going to effect that entry, when we're going to journalize it, because this will represent credits to close that account, it means we'll have to go and debit the account, right? And the purchase returns, now we must just go and see what the purchase returns amounted to. There we can see purchase returns amounted to 12,450. So we'll have an account called purchases returns, and at this stage, before we close it, it'll have a credit balance of 12,450. So now let's go and close that journal, that account by means of a journal entry. There we go. We already have a credit balance, but we want to get rid of that balance. It means we're going to debit purchase returns. To get rid of the balance, we want to close it off to 0. The balance on that account, the credit balance at this stage is 12,450. We want to bring it down to zero, so we've got to debit it with that full amount. Where are we going to take it? We want to net it off with our purchases, so we're going to take it to our purchases account, right? That same amount. So we credit purchases. That is what we did here in our calculation as well. Remember, before we determined our net purchases, we deducted the purchase returns there to arrive at our net purchases. So here we do it by means of a journal entry to effect exactly what we've mentioned there. Okay, and that one we've already answered. Right, ladies and gents, we have done the full paper from last year. Like we said at the beginning, you're not going to have a physical paper in front of you, but it's going to be questions that are very similar. It's going to be similar. It's going to be slightly different because you're doing an online test, but the principles, the kinds of questions that you need to answer will be exactly the same. So I'm going to stop sharing my screen now. Unless there's anything else you want to let me just do that. Unless there's anything else you want to know, perhaps before you ask questions, let's just ask from Dr. Smith, Dr. Sunette Smith. Is there anything that she would like to add at this stage?
No, Mr. Janssen van Rensburg. Yeah, the students just need to make sure they revise all the work that's on ClickUp, and this is also an important part of the revision, what you did today. And as I said earlier, they must please also try the revision quiz on inventory calculations. So there's a lot to go through, and good luck for the test tomorrow.
Yes, thank you, Dr. Smith. You know, students, you might be too young to know, but there was a famous golf player in I guess it was probably the 1970s and 80s, because I was fairly relatively young, called Gary Player. And he, in his golfing career, he had quite a number of either hole-in-ones in golf, or he hit his first drive very close to the putt. And at one stage, a reporter, I think it was in Augusta in America at the US Open, asked him, "Mr. Player, how are you so lucky?" And he replied, "You know, the more I practice, the luckier I get." So that is what Dr. Smith says. Please practice, practice, practice. Go through all of those examples, the quizzes, all the material that she has kindly posted for us there. And then the more you practice it, the luckier you'll get in the exams. Okay, students, are there any questions? We'll give you, let's say, 120 seconds. Unless there are lots of questions, then we'll give you until our time runs out. But if there are no questions, we'll just maybe wait for a minute or two. Any questions from your side? You are welcome to type it or to activate your microphone, unmute your microphone and ask it. There doesn't seem to be any questions. Okay, so like Dr. Smith said, good luck tomorrow. But like I say, the more you practice, the less luck you need, because you've got more skill. Manla just wants asked there the periodic and perpetual system, please, for the last time. Manla, I'm just going to go through it very briefly, but remember that we are going to load the recording of this session to the site. Thank you, Nkosana. So you can listen to the whole recording again. So if there's anything unclear, you can listen to it. You can re-listen to it. You can go through it as many times as you wish. We're not sending you the link to the recording, because then it costs you data. We download it and then we upload it to the actual Blackboard site, which then means you can listen to it without incurring any data costs. Nompumelelo, you ask, will this session be available on Blackboard? Yes, it will be. It takes about, I guess this one is going to be more or less, let's see the time, it's going to be more or less an hour and 35 minutes. So it's going to take about half an hour to 35 minutes for it to get processed on Blackboard. So I cannot download it unless it's processed. So that will take about, let's say, 40 minutes. Then once it's been downloaded, then I will upload it. Now my upload is a bit slower. So I would, if I can give you an ETA or estimated time of arrival, I would say from about 2 o'clock this afternoon, it should be on all available on all the sites. So if you go to the folder that has got your content per topic, there is a subfolder there. I think I even made it red. That contains it. I think it's called recordings of interactive sessions. Right, recordings of interactive sessions. You will find it there, but like I said, don't go looking for it before more or less 2 o'clock. Manda, is it okay that I then do not answer your question now? I see you typed there, okay, sir, or do you want me to go through it again briefly, or are you happy to just go and listen to the recording again? Thank you, Mandla. Okay, so after 2 o'clock, it should be available. Then you can listen to the recording. Lauren, yes, it is true. We know it is a bit of a delicate balancing act or trapeze act. We do not want to get the employers angry with us. So we do send invitations to the part-time students to the full-time sessions, but I know that in your case, it'll probably be best to perhaps, if you have duties at your place of employ to do, to rather maybe just wait for the recording. Sorry about that. That is just unfortunately the situation that we have. Thank you, Mandla. Thank you, Lauren. Okay, ladies and gents, Dr. Smith, I think then I'm going to stop the recording and then we'll close this session. If there are any further questions, you can always send an email to your lecturer. Thanks, students. Happy writing tomorrow. Keep well. Cheers.